Hey friends, have you ever dreamed of generating enough passive dividend income to cover all your monthly expenses? What if I told you it's possible to earn $2,900 per month in dividends? In today's video, I'll share the fastest ways to realistically achieve this goal. Whether you're close to retirement or just starting out, dividends can provide recurring cash flow to replace or supplement your salary. With the right strategies, you can speed up the journey to living completely off your investment income. Let's explore some high-yield options that can get you to $2,900 per month, faster than traditional dividend stocks. Get ready to take notes. First, we need to talk about the magical number. How much monthly income you really need to cover expenses and live comfortably. For this example, we'll use $2,900 or $35,000 per year. But in reality, you need to run the numbers based on your personal lifestyle, obligations, and retirement goals. Be honest with yourself about the income you require. Consider your fixed costs like housing, transportation, food, utilities, and healthcare. Factor in discretionary spending on entertainment, travel, shopping, and hobbies. And account for any large one-time expenses. Add it all up and build in a buffer. This gives you a realistic target for the dividend income you need to earn monthly. Use an expense tracking app and budgeting tools to arrive at an accurate estimate. Once you have a target, we can back into an investment amount that can generate the dividends to hit that goal. Different strategies will require different amounts due to varied dividend yields. All right, ready to find out how you can realistically earn $2,900 a month in dividends? Let's dive in. One of the fastest ways to generate large dividends is through covered call ETFs. They invest in stocks, but also sell options contracts. This provides income from two sources, dividends and option premiums. Popular covered call ETFs like XYLD, QYLD, and RYLD can offer yields over 10%. Compared to 2 to 3% from regular dividend stocks, that's huge. For example, with a 10% yield, you'd need to invest around $350,000 in one of these funds to earn $2,900 per month in dividends. That's much more feasible than over $1 million in normal dividend stocks. While covered call strategies come with risks, they offer a realistic path to replacing your salary entirely with dividends. Worth considering if you want income fast. Now let's do a deeper dive on how covered call ETFs work and the pros and cons. Covered call funds hold a portfolio of stock, just like regular ETFs. However, they use options trading strategies to generate additional income from those stocks. Here's how it works. The fund sells call options on the stocks they own, collecting premiums from the buyers. The buyer gets the right to purchase the stock at a set price before expiration. If the stock stays below that price, the option expires worthless and the fund keeps the premium. If the stock rises above the price, the fund may have to sell at the agreed price, capping gains. By repeatedly selling options on its holdings, the ETF brings in steady income on top of the dividends. This results in very high dividend yields. The cons are that covered calls limit upside potential in strong bull markets compared to owning the stock outright. There's also added complexity and risk involved with options trading. But for our goal of generating consistent monthly dividend income, covered call ETFs offer a compelling advantage. The amplified yields provide dividends faster. Another attractive option is investing in real estate investment trusts, or REITs. These own properties and pay 90% of income as dividends. Certain REITs focused on malls, mortgages, and niche real estate yield 10% or more. For example, investing around $350,000 in a 10% REIT could generate $2,900 monthly. Historically, REITs also gain value over time, so your income can rise as the portfolio grows. Downsides are risks if property values decline, but overall, REITs provide a solid option for fast dividend growth. Now, let's take a deeper look at REITs and how they work. REIT stands for Real Estate Investment Trust. As the name implies, a REIT invests directly in real estate properties and assets. Some examples are apartment buildings, data centers, cell towers, warehouses, shopping malls, hotels, self-storage units, and more. REITs allow everyday investors to gain exposure to these real estate assets without having to buy physical properties themselves. REITs make money by collecting income from their real estate holdings through rents, leases, and property sales. By law, they must pay out at least 90% of taxable income to shareholders in the form of dividends. This results in high dividend yields. REITs offer diversity because they hold interest in hundreds of properties across sectors and geographic regions. Risks to consider are sensitivity to interest rates, economic declines, and oversupply in certain property segments. But overall, REITs provide attractive income. Dividend ETFs. For those wanting a more diversified approach, certain ETFs offer higher yields by focusing on dividend stocks. These provide one-stop access to many companies across sectors. For example, SCHD owns quality dividend payers like Coca-Cola, Chevron, and Home Depot, and yields around 3.5% today. To hit $2,900 monthly, you'd need to invest around $1 million in SCHD, or a similar ETF. The benefit is you remove stock-specific risk by owning hundreds of dividend payers in one fund. The trade-off is requiring more capital upfront to hit your income goal. Now, let's take a closer look at dividend ETFs and how they provide a diversified approach. Dividend ETFs hold a basket of stocks, specifically focused on companies with higher dividend yields. This provides instant diversification across many dividend-paying stocks across all sectors. Examples include SCHD, VIG, and NOBL. These ETFs screen for stocks with healthy balance sheets, consistent profitability, and commitment to maintaining and growing the dividend over time. The funds rebalance and manage the portfolio of dividend payers, so you get exposure to leading income stocks without having to select them yourself. Dividend ETFs remove the risk of relying too heavily on just a few individual stocks. The trade-off is, the yields are not as high as owning a few select dividend stocks. But the set-it-and-forget approach makes dividend ETFs attractive for passive income. They provide stability and simplicity. Dividend stocks. Finally, we can't ignore traditional dividend stocks. Investing in quality companies like Microsoft, Apple, and Coca-Cola can provide steady, growing income over time. The issue is, most dividend stocks yield only 0.5 to 3%, so you will need upwards of $1.2 million invested to generate $2,900 monthly in dividends. The advantage, however, is owning stock in elite established companies poised for growth. Over decades, reinvesting and compounding dividends allows your income to rise. Now let's take a closer look at building a portfolio with traditional dividend stocks. Dividend stocks are companies that pay out a portion of profits directly to shareholders as cash dividends. Historically, dividends account for a large portion of total stock market returns. Focusing on companies with consistent profitability, durable competitive advantages, and commitment to growing the dividend can lead to a rising income stream. Blue chip stocks like Microsoft, Johnson & Johnson, Procter & Gamble, and Coca-Cola have impressive track records of dividend growth. Owning a diversified portfolio of these elite dividend payers reduces risk while allowing the income to compound over time. Patience and a long-term outlook are required, but dividends from stock provide an attractive source of passive income. The right mix. As you can see, there are multiple paths to generating your desired monthly income. The key is finding the right mix based on your time frame, risk tolerance, and starting capital. Covered call funds and REITs provide fast income potential, but involve more risk. High-quality dividend stocks and ETFs offer steady rewards, given enough time and continual investments. I recommend speaking to a financial advisor to determine a balanced allocation across dividend strategies tailored to your situation. Be open to combining high-yield and low-risk assets. For example, you might put 50% into covered call ETFs, 30% in dividend ETFs, and 20% in individual stocks. Or 40% in REITs, 40% in dividend ETFs, 20% in bonds. Work with your advisor to create the optimal blend of assets driven by your income goals, risk appetite, and investment time frame. Stay disciplined in following the plan. Yes, it is possible to realistically earn thousands in monthly dividends to cover your expenses. With the right roadmap and commitment, dividend investing can pave the way to financial freedom faster than you may think. What's your preferred dividend investment strategy? Comment below. If you enjoyed this video, do like and share this video so that more people will learn about how to live off dividends in the shortest time. Check out this playlist of my top 10 videos for creating wealth, and I'll see you in the next video. Take care.